Well, with this topic from psychology that I presented to you, dear ones, considering the third principle of technical analysis, that history repeats itself, we want to gradually, as we move forward, make our journey more and more exciting. We want to delve into the first technical analysis method in the capital market and learn the beauties of technical analysis together here. Well, in the science of technical analysis, when the stock price, in fact, the stock price chart keeps repeating its behavior, and this repetition is the result of our own economic behaviors as investors, which we learned in the third principle of technical analysis. This repetition of history, creates a series of geometric arrangements that we call price patterns or price formations. Price patterns are divided into two categories. In general, we have two categories of price patterns. The first category includes reversal patterns, which we call reversal price patterns or reversal price formations. And the second category, we call them consolidation price patterns or consolidation price formations. In Persian, they're called consolidation price patterns. Now, these reversal price patterns and consolidation price patterns are divided into several categories, which we want to discuss. So, I explained the nature of the patterns to you and mentioned that the first category of patterns are the reversal patterns. Look, kids, what are reversal patterns? Reversal price patterns are those types of trends that, when formed, change the behavior of the stock's price chart. What does that mean? It means we have an upward chart. Let's assume we have an upward price chart. This chart is continuously growing. Here, the pattern we are interested in forms. This means our reversal pattern forms. Pay attention whenever a reversal pattern forms. Whenever a reversal pattern forms on the stock's price chart, it changes the chart's behavior. What does this mean? It means if the chart was upward and the pattern formed, the chart would become downward. If the chart was downward, the pattern formed, the chart would become upward. So, in reversal patterns, we observe a change in the behavior of the stock's price chart. Now, based on this definition, I want to teach you some of the most important reversal patterns. But before we get into the reversal patterns, let me give an explanation about key consolidation patterns. What are consolidation patterns, guys? Consolidation patterns occur when the price chart of a stock is in a trend, and these patterns form without changing the behavior of the chart, but rather they allow the chart to continue its previous trend with strength. For example, in an upward trend, a consolidation pattern forms here, causing the trend to continue upward with strength. In a downward chart, a consolidation pattern forms here, causing the chart to continue its decline with strength. In other words, its behavior does not change. Or in simpler terms, we can say it like this. We can say that when a consolidation pattern forms, it's as if the chart is taking a break, refueling, and then continues its trend with more strength. We call these patterns consolidation or consolidative patterns. All right, let's go and actually see these patterns together, how they look and how they work. Before we, look at the patterns themselves, there's a very important point that you need to keep in mind. We call it the initial conditions for a breakout. I call it a breakout or breakdown. In a pattern occurs when three features happen, as you can see in this slide. What does a breakout mean? Look, guys, we have an upward trend. We have an upward trend. In this upward trend, when a pattern forms, it changes direction from a point on the chart where the breakout or breakdown point occurs. So it's always from the breakout point that we see the result of the pattern. And conversely, a pattern forms in a downward trend. A breakout point must occur here. From the breakout point onward, the result of this pattern is seen. So when does this breakout pattern occur? When the mentioned trend is broken, meaning it's a downward trend. Suddenly, we see signs of reversal on the chart, or it's upward, and we see signs of a downward reversal on the chart. This is the first feature. The second feature is that the pattern should form with all geometric criteria. I will now tell you about these geometric criteria regarding the patterns. But the second rule of the breakout is that when the chart is created, this pattern that I am teaching you now, so we can learn these patterns together, must be fully formed, kids. When a pattern is still incomplete, we cannot say that this chart will fall. The pattern must be complete. It must be fully formed, completely established. Once it is fully formed, we can say that the breakout point is about to occur. And the next factor is that the breakout must occur with high strength, and the trading volume should show a noticeable high increase. That is, we should see a large volume of trades there, which I will explain to you on the stock price chart so you can fully understand what happens. You just need to know that my breakout points occur when, firstly, the chart breaks. Secondly, the pattern is fully formed with all its characteristics. And thirdly, a significant trading volume is generated at that point. When these three main factors are present, I can say that my breakout point has been established. And from that breakout point, I will witness the outcome of that price pattern. Now let's move forward, and I will explain it to you on the chart so that you can understand it more easily.